Barry covered your work for a long time, and you are looking at levels that typical recessions have given us and then shorter shocks have given us, and are trying to almost split the difference. Can you talk about it?
Yeah, we had said 2,300 plus or minus 250 is a range. Yesterday, we actually bounced off that 2,300 midpoint. But I'll tell you, Carl, I think we're very, very close to either a low or a powerful counter-trend rally. Some of the things that I look at are the resistance of the VIX, the high yield spreads blowing out above the 2016 highs when a lot of energy companies did go broke, as well as the defensives relative to cyclical sectors, which have gone parabolic and look like they're approaching levels that typically would indicate a peak. The other thing is the gold to oil ratio, which measures near-term deflationary pressure. We're having an enormous spike in that ratio, which tells us the deflationary pressures are huge. But we will, I think, get a bounce very soon in the stock market.
Keith, how about you? Tactically, as Barry was saying, what's your playbook?
Yeah, we've been seeing similar things where a level in the S&P about 2,500 was pricing in a typical recession. I think the struggle for investors is that this is not typical when we just downgraded our Q2 GDP forecast for the U.S. to negative 9.5%, so mirrors of the financial crisis. So playbook for me is looking for circuit breakers. Barry mentioned a few, but number one, it's all about the coronavirus thus far. Tracking new cases. We put out a daily search tracker for symptoms and sentiment that could potentially lead that. And then also announcement FDA today about a potential treatment. We're seeing news about antiviral drugs that could potentially reduce that risk of mortality, which I think is key for sentiment. I would say number two, on the policy side, monetary, looking for rates volatility to settle down and real rates to stop rising. We talked a bit about the fiscal. The key to me and my takeaway is that this is much more tilted to the consumer rather than the corporate. So the consumers will be the one net saving in this, and coming out then would probably be tilted much more towards consumer staples, discretionary, even healthcare near term, rather than, say, capital goods, which tend to lag as we get that profit hit.
Barry, I want to go back to what you just said. I think you used the word typical, actually. It's pretty incredible to think that it's been 1 month as of today since the S&P 500 hit its last record highs. We're now down, nearly 30% on the average, fastest bear market ever. But when you see things like issues around liquidity in the Treasury market, you see the squeeze on the dollar that's getting a lot of attention right now. Some of the other moves, maybe breaks in terms of correlation across different asset classes. Does that still feel typical to you in a time of a bear market?
No, and it's never been typical. I think we are seeing enormous strains on the market. I mean, there's going to be a cost, a long-term cost associated with double-barreled fiscal and monetary stimulus, which is enormous. We're also going to see an acceleration of deglobalization of supply chains. And unfortunately, we're going to see an increase in the role of government in corporate governance. I actually think that 2020 to 2022 marks the end of a disinflation era with a deflationary crescendo. Just like 1980 to 82 marked the end of a 20-year inflationary era with a double-dip recession and a double-dip stock market. So any powerful counter-trend rally that we may see will struggle to get above where we were a month ago. And were it to do so, I would actually probably turn bearish, because I think we see another downdraft when we realize that PE multiple compression, dollar weakness, low total returns, and a possible growth to value rotation are on the horizon.
Yeah, Keith, that would be a long way up from here to get to where we were. And you were talking about the health improvement as an impact on this. I wonder, it seems to me that the longer this lasts, in terms of the slowdown in economic activity, the partial quarantines, the more potential permanent damage to the economy and to a certain segment of the consumer. Is that the way you're looking at it, where if we go well into April and beyond with this sort of restrained economic activity, the longer we're holding our breath, the more it hurts?
I think so. I think, one, just from a human element, that the longer this lasts, the more potential permanent changes to sentiment, that those checks may not get spent. That second, the hit to corporates for every 1 week, if you think 50 weeks roughly in the year, every week lost is 2% of the year. And so as you start getting 4 weeks, 8%, 2 months, 16% of a year, small and medium-sized businesses, that's pretty tough to handle. And I think the other part is the longer that it lasts, we have seen a change in mindset, potentially politically, amongst individuals and then corporates. I think if you use, say, the energy playbook of 2015-16, a lot of thought that we'd have mass bankruptcies, and we didn't, because there was a belief amongst banks and energy companies that prices would recover. And so you got those loans to bridge that gap. I think the longer this goes on, the greater that risk of breaking down of trust and funding that profit shock, a cash flow shock across the economy.